Welcome! In this video, will the attack start for XEN? We will analyze it. Don't forget to subscribe, like, and please watch to the end to understand.
First of all, the concept of a downtrend is among the most closely watched structures in technical analysis by investors and traders. A downtrend occurs when prices move consistently downward over a certain period of time and is generally characterized by successive lower highs and lower lows. In other words, even if the price attempts to move upward, each attempt fails to surpass the previous high and the downward pressure continues. For this reason, a downtrend shows that selling pressure dominates the market and that buyers remain weak. However, the most important point to remember is that no trend lasts forever. Every downtrend has the possibility of eventually breaking, and it is precisely at this breaking point that a new upward movement may begin. When the price breaks above the downtrend line from a technical perspective, it signals that the balance in the market has shifted. After being under the control of sellers for a long time, if the price finally moves above this trend line due to strong buying pressure, the prevailing psychological outlook also begins to change. Because in technical analysis, trend lines are not just mathematical or graphical tools, but also a reflection of investor psychology. The presence of a downtrend line indicates that a large group of market participants are positioned towards selling, whereas the breaking of this trend suggests that this group's mindset is starting to change. Therefore, breaking a downtrend is not merely the passing of a line on the chart, it can be a sign of a much deeper shift in market behavior. When a downtrend is broken, price movement usually gains momentum. The reason is this: there has been a trend line continuously suppressing the price, with sellers stepping in every time it was tested. But when the price breaks through the trend with strong volume, sellers lose their strength while buyers gain a psychological advantage. At this point, many investors interpret the trend break as a buy signal and enter the market as new buyers. At the same time, traders who have been consistently selling or holding short positions during the downtrend hit their stop-loss levels and are forced to close their positions. This creates additional buying pressure that further supports the upward movement. In other words, breaking a downtrend is not only a technical reversal, but also brings about a chain psychological effect. For this breakout to be sustainable, it is generally expected that the price will close above the trend line several times, because sometimes false breakouts occur when the price temporarily moves above the trend line but quickly falls back down. This is why professional investors want to see confirmation after a trend break. This confirmation can be obtained if the price retests the broken trend line as support and then bounces strongly upward from it. If the price successfully passes this test, it becomes clear that the downtrend has ended and a new uptrend has begun. This strengthens buyer confidence and can kick off a new wave of upward movement in the market. Particularly on long-term charts, such as daily or weekly timeframes, the breaking of a downtrend carries far greater significance. Because downtrends in shorter timeframes are broken more frequently and are often limited to short-term movements. However, the breaking of a downtrend that has persisted in long-term charts can be a signal of a fundamental market shift. This is why major investors, funds, and institutional buyers closely follow such major trend breaks. When such a breakout occurs, not only retail investors but also large amounts of capital may enter the market, which can cause the price to rapidly begin an upward rally. From a psychological standpoint, pessimism generally dominates the market during a downtrend. Most investors believe that the price will continue to fall, which is why they either sell their assets or stay away from the market entirely. But when the trend breaks, this pessimistic picture suddenly begins to change. Even investors who previously did not believe in a price increase may start leaning towards buying after seeing the breakout. This strengthens the upward momentum of the price. That's why downtrend breakouts are not only technical, but also psychological turning points. In addition, when a downtrend is broken, a clear increase in trading volume is often observed. Volume is one of the most important factors confirming the strength of a breakout, because a low volume breakout is rarely sustainable. But when volume is high, it shows that there is truly strong buying pressure in the market and that the breakout is not false. This is why professional investors always evaluate trend breakouts together with volume. If a breakout is supported by increasing volume, it signals that the price may enter a strong uptrend in the upcoming period. The breaking of a downtrend brings not only upward potential, but also risks. Because during trend breakouts, the price sometimes moves too fast and investors may panic buy. After such panic buying, short-term corrections are quite natural. This is why it's important for investors to remain calm and act with a strategic plan. A trend breakout can be a buying opportunity, but without risk management, any trade can put an investor in a difficult position. That's why it's necessary to set stop-loss levels, maintain balanced portfolio management, and avoid acting hastily. In conclusion, a downtrend is a strong structure that shows sellers have dominated the market for a period of time. However, when the price breaks this trend, it signals a change in market balance and that buyers are gaining strength. After such a breakout, the price often enters a new uptrend, with both technical and psychological factors starting to favor the buyers. Increasing volume, growing buyer confidence, weakening sellers, and new investors entering the market all contribute to pushing the price further upward. Of course, false breakouts and short-term corrections can occur, but overall, breaking a downtrend is considered a very positive development for investors and may also be a signal of major rallies in the future. But we can't base our analysis on trends alone, so let's also look at other metrics. Stay tuned.
The breakout of a downtrend in the RSI indicator, followed by a retest phase, is actually a very strong technical signal and marks an important turning point in terms of price action. This is because RSI, the Relative Strength Index, is one of the most critical oscillators that helps us read buying and selling pressure in the market. The trends formed within this indicator often strongly align with the trends seen in price charts. Especially when a downtrend breaks, it shows that selling pressure in the market is weakening and buyers are beginning to gain strength. In such a case, the breakup of the RSI downtrend is actually the first step of a bullish signal. The retest phase, on the other hand, serves as a second confirmation mechanism, testing the strength of the breakout and increasing investor confidence. When a downtrend is drawn on the RSI, this line is usually plotted through the descending peak points formed by the indicator during a price downtrend. The combination of these peaks shows that selling pressure is consistently stopping the RSI at lower levels with each attempt. In other words, as long as the RSI is under the downtrend, the market remains under constant pressure. However, once a breakout occurs, this pressure mechanism is disabled and the market begins to establish a new balance of power. At this stage, it is especially important whether the price movement confirms the RSI breakout. While the RSI breakout alone is a signal, the price also gaining upward momentum strengthens it further. If the price simultaneously breaks resistance levels, it is possible to say that buyers are gaining significant control over the market. The retest phase makes things even more interesting. Retest means the broken trend line is tested again. That is, after the RSI breaks above the downtrend line, it may return to touch that line. If during this touch, the trend line acts as support and the RSI continues its upward reaction, it confirms that the breakout is not false and that a real trend reversal has begun. Investor psychology also plays a key role here. Many traders approach the initial breakout with skepticism. However, when support holds during the retest, confidence increases, leading to more buyers entering the market. This paves the way for stronger price momentum. Additionally, when RSI breaks a trend and retests successfully, it usually signals that the price is preparing for sharp rallies ahead. Since RSI measures momentum, the breaking of a downtrend shows momentum shifting from selling pressure to buying pressure. While this momentum shift may create small short-term fluctuations in price, it can signal significant rallies in the medium to long term. Particularly when RSI rises above the 50 level and maintains it, it indicates that bullish momentum is strengthening. If RSI then advances toward the 60-70 range, it is possible to say that the price has entered a strong bull trend. During the retest, RSI holding above the 50 level is one of the strongest signs supporting this view. Another key detail is that RSI trend breakouts are often mirrored by similar breakouts in the price chart. If the RSI downtrend is broken, most of the time a downtrend line on the price chart is broken as well. Having both signals occur simultaneously provides much stronger confirmation for investors. During the retest, if the price also tests a former resistance level as support, the setup becomes even more reliable. Therefore, the retest phase in RSI is significant, not only in terms of the indicator, but also in the price structure. The fact that both the RSI and the price break out and then pull back to find support in the same areas shows strong alignment and creates a picture that the market is preparing for a rally. Another importance of RSI retests is that they show whether the trend will be sustainable. Sometimes RSI trend breakouts are not confirmed by price, and shortly after, the indicator falls back into its old trend. In this case, it is considered a false breakout. However, when the retest is successful, meaning RSI finds support at the downtrend line and turns upward again, the likelihood of a false breakout is greatly reduced. For this reason, the retest phase acts as a kind of safety filter for investors. It helps traders open positions more carefully. Those who enter during the breakout take on more risk, while those who enter after the retest trade on more solid ground. This structure is often seen at the beginning of bull markets. When RSI breaks long-lasting downtrends, it signals that the market is entering a new phase. Retests then confirm this transition.
The falling wedge pattern is a very strong and noteworthy structure in technical analysis.
Throughout price movements, it gradually narrows and creates a downward appearance, usually emerging at the end of downtrends or during a correction phase. Although prices seem to be compressing downward in this pattern, it actually shows that the power of sellers in the market is gradually diminishing while buyers are slowly beginning to take the stage. Because even though each new low is lower than the previous one, these declines gradually weaken, momentum is lost, and at some point, the price presses against the upper line of this structure. It is precisely here, with the breakout of the upper trend line, that strong buying appetite emerges and the market begins a serious upward rally. For this reason, the falling wedge is one of the most closely followed reversal patterns by investors. Especially due to its ability to change the course of the trend, the breakout of this pattern usually sets the stage for major price movements. At the point where the price approaches the upper line of the falling wedge, an important psychological process also takes place, because in this region, the pressure from sellers gradually decreases while the appetite of buyers begins to strengthen. The narrowing structure of the wedge represents compression in the market. While investors wait for this compression to break, trading volume often declines. This drop in volume is usually a harbinger of a major breakout, because investors who have remained neutral in the market act immediately once the direction of the breakout becomes clear. Especially when the price breaks out of the upper trend line to the upside, this is not only a technical signal, but also psychological victory. Buyers have now seized dominance in the market. Following this breakout, a sharp increase in volume is often observed. A breakout supported by volume is much stronger and more sustainable. This is why it is so important to wait for the price to move above the upper line, as this movement indicates that the trend has changed and a new upward wave has begun. Waiting for the breakout of the falling wedge requires patience. Many investors can make mistakes by acting too early while the price is compressing, but being hasty often leads to losses, because entering a trade before the pattern is fully formed means taking on risk without fully confirming the market's direction. The healthiest approach is to wait for the price to clearly break the upper trend line, ideally with volume to support it. When this occurs, the reliability of the signal is very high. In addition, it is often possible for the price to return for a while to test the line it broke. In technical analysis, this movement is called a throwback, and it often provides investors with a second entry opportunity. Therefore, monitoring both the breakout itself and possible pullbacks allows for safer trading strategies. The most striking aspect of the falling wedge pattern is that although it looks bearish, it is actually preparing for a bullish move. This is why it is often considered a bullish pattern in technical analysis, because while prices are compressing downward, this compression shows that buyers are gaining strength while sellers are beginning to retreat from the market. Especially the fact that each new low occurs at increasingly smaller intervals reveals that sellers are having difficulty pushing the market down further. This is why reaching the upper line and breaking it is almost like a turning point. After this breakout, investors usually start buying aggressively. The rallies that occur after the breakout can sometimes be very sharp, and the price can surpass important resistance levels in a short time. This creates highly profitable opportunities for investors. Another element to pay attention to during the breakout of the wedge is the overall market trend. If the falling wedge has formed at the end of a long-term downtrend, this is usually a strong indication that the trend will completely reverse and a new upward phase will begin. However, if this pattern has formed as a correction within an uptrend, then the breakout indicates the continuation of the uptrend. In other words, the falling wedge can be both a reversal signal and a continuation signal. What matters here is the price breaking the upper line and carefully observing the direction in which the market gains momentum after the breakout. Since this breakout is most often upward, investors interpret the pattern as bullish, but confirmation is always necessary. Another factor investors should consider in this process is support and resistance zones. When the price breaks the upper trend line, the first significant resistance point it encounters will often test the strength of the breakout. If the price surpasses this level with volume and strength, the path for an uptrend opens. However, if the price struggles at this level, short-term pullbacks may occur. This is why the falling wedge breakout is a signal on its own, but provides much healthier results when assessed along with other technical levels. For example, Fibonacci levels, moving averages, or previous horizontal support and resistance zones can offer important clues about the potential targets of the price after the breakout. The falling wedge pattern is important not only in terms of technical analysis, but also in understanding investors' psychology, because throughout this pattern, uncertainty dominates the market. While some investors think the declines will continue, others sense that a buying opportunity is approaching. This contradiction causes the price to compress. But at the moment of breakout, uncertainty disappears and everyone starts moving in the same direction. This is why the falling wedge breakout is usually very sharp and strong, because even neutral investors in the market have now chosen their direction. This collective move pushes the price upward quickly, so the breakout is not only technical but also a psychological turning point. One of the scenarios that can occur after the breakout is the price rising rapidly and reaching its targets in a short time. In this case, quick profit opportunities arise for investors. In another scenario, the price may show a gradual increase after the breakout. In this case, the rise is slower but more stable. In both situations, the important point is confirming that buyers have seized control with the breakout of the pattern. Long-term investors usually see such breakouts as the beginning of a trend reversal and position themselves accordingly. Short-term investors, on the other hand, tend to take advantage of the breakout moment and its immediate aftermath. Regardless of the strategy, the breakout of the falling wedge pattern is interpreted as a highly positive development in technical analysis. In conclusion, the falling wedge structure is a very valuable pattern that shows compression in the market and the gradual weakening of downward pressure. The breakout of the upper line is a strong indication that this compression has ended and that a new upward rally has begun. This is why the most critical point for investors is to be patient and wait for the breakout. Acting early is often risky, but the breakout moment provides a reliable and strong signal. A breakout supported by volume confirms that the trend has changed and that the price has gained new momentum. This allows investors to take positions with confidence. Possible pullbacks in price after the breakout also create additional opportunities. For all these reasons, the upward breakout of the falling wedge pattern is considered one of the strongest bullish signals in the market.
Yes, friends, I hope you liked the video. If you subscribe to my channel and like the video, more videos will be coming. Be careful in your investments, analyze the risks correctly, and always take strategic steps. I will be with you with different analysis, investment opportunities, and technical information in my videos. I wish you all a lot of profit. See you soon.